Right now, while most people are distracted by stock market headlines and political drama, something much quieter and far more dangerous is unfolding behind the scenes. Banks that once claimed to have endless access to physical silver are suddenly moving differently. Deliveries are slowing. Vault reports are getting harder to interpret. And insiders are starting to whisper about a problem no one wants to say out loud. Physical silver may not be where it's supposed to be. If this trend continues, the ripple effects could hit financial markets faster than anyone expects. Before we go deeper, take 1 second to like this video and subscribe to The Silent Collapse. This channel is built for people who want to see financial warning signs early, not after the damage is already done. Subscribing helps you stay ahead of shifts that mainstream headlines usually ignore until it's too late. What makes this situation so unusual is not just price movement. Silver has always been volatile. What's different now is behavior. Banks, institutions, and large traders are acting more defensive than at any time in recent memory. When markets are healthy, physical supply flows smoothly. Buyers place orders, sellers deliver, and vault levels remain relatively stable. But when institutions begin delaying settlements, shifting contracts to cash payments, or quietly reducing exposure, it often signals stress building under the surface. For decades, the silver market has operated on a system built mostly on paper promises. Futures contracts, ETFs, and derivative products created the impression that silver was abundant and easy to access. In reality, the physical supply has always been much tighter than reported. The system works only when most participants settle in cash and never ask for actual delivery. The moment too many people want the real metal at the same time, the illusion begins to crack. Over the past few months, inventory data has started to tell a different story. Registered silver levels, the portion of silver actually available for delivery, have been shrinking while demand remains elevated. Industrial consumption continues to rise due to solar panels, electric vehicles, and advanced electronics. Meanwhile, mining output has not increased at the pace needed to balance this demand. That gap creates pressure, and pressure in commodity markets rarely disappears quietly. Insiders in trading circles have started noticing unusual patterns. Lease rates for silver have ticked higher, which often indicates that institutions are competing to secure short-term supply. Backwardation signals have appeared more frequently, meaning buyers are willing to pay more for immediate delivery than future contracts. These are not normal conditions in a well-supplied market. These are early warning signs that physical metal is becoming harder to source. Banks are in a particularly sensitive position. Many of them act as market makers, meaning they provide liquidity and stability in futures markets. To do this, they hold complex positions that rely on predictable price movements and available supply. When physical silver tightens, these positions become riskier. A sudden surge in demand for delivery could force banks to buy metal at higher prices, increasing losses and exposing leverage that was never meant to be tested under stress. This is where forecasts start becoming more serious. Analysts who track physical flows rather than just price charts are warning that the silver market could face a supply squeeze unlike anything seen in decades. If industrial demand continues rising while investment demand accelerates, the available inventory could drop below critical levels. At that point, price becomes less about speculation and more about necessity. Buyers who truly need silver for production will pay almost any price to secure it. There are also reports from wholesalers and dealers suggesting longer wait times for large physical orders. Premiums on coins and bars have remained elevated compared to historical norms. While these signals may seem small individually, together they form a pattern that experienced traders recognize as tightening supply. Market manipulation discussions have resurfaced as well. For years, critics argued that silver prices were suppressed through heavy paper selling designed to keep inflation signals under control. Whether or not one fully agrees with that view, it is undeniable that leverage in silver markets is significantly higher than the amount of physical metal backing those contracts. When leverage meets scarcity, price adjustments can become violent. If banks are indeed running lower on accessible physical silver, their response would likely be gradual and quiet at first. They might reduce short positions, encourage cash settlements, or shift exposure to avoid triggering panic. But markets have a way of detecting stress long before official statements confirm it. Sudden spikes in volatility, unexpected delivery delays, and policy adjustments often reveal more than press releases ever will. What makes silver particularly sensitive compared to gold is its dual role. Gold is primarily a store of value, while silver is both monetary and industrial. That means shortages affect not only investors, but entire manufacturing sectors. A disruption in silver supply could impact energy infrastructure, electronics production, and even medical technology. This adds urgency that amplifies price reactions. Another factor adding pressure is global uncertainty. Economic slowdowns, rising debt levels, and currency fluctuations have pushed more investors toward hard assets. When confidence in financial systems weakens, demand for tangible stores of value increases. Silver, being more affordable than gold, attracts both large institutions and everyday investors during these periods. At The Silent Collapse, we focus on connecting these signals before they become obvious. Right now, the connection is clear. Inventory trends, industrial demand, institutional behavior, and global economic stress are all pointing in the same direction. While this does not guarantee an immediate supply crisis, it does suggest that the margin for error is shrinking quickly. The question many people are asking is what happens if delivery demands suddenly surge. History shows that exchanges may intervene during extreme conditions. Trading rules can change. Cash settlements may replace physical delivery. Volatility limits can be introduced. These measures are designed to stabilize markets, but they can also reduce trust among participants who expect transparent pricing. Trust is the foundation of financial systems. Once confidence begins to erode, reactions accelerate. Investors who once felt comfortable holding paper contracts may shift toward physical assets. Institutions may reduce exposure. Liquidity can dry up when it is needed most. These shifts do not happen overnight, but when they gain momentum, they move faster than most people anticipate. Some forecasts suggest that if current trends continue, silver prices could experience significant upward pressure within the next few years. However, price alone is not the main concern. The real issue is what rapid price increases reveal about supply constraints and institutional stability. When metals move sharply, they often signal broader economic stress rather than isolated events. For everyday viewers, the key takeaway is awareness. Markets often give subtle warnings before major changes occur. Watching physical delivery data, industrial demand reports, and institutional behavior provides a clearer picture than headlines focused only on price swings. Right now, banks are not making loud announcements. They rarely do during early stages of stress. Instead, they adjust strategies quietly. Reduced exposure, altered trading patterns, and shifts in communication can all indicate caution behind the scenes. Observers who pay attention to these details often spot turning points before the general public. As we move forward, the silver market may become one of the most important indicators of financial system health. Its unique role connects industry, investment, and currency stability in ways few assets can. If supply tightens further, the response will not be limited to metals markets. It could influence broader economic confidence. The most important thing to remember is that markets rarely break without warning. They whisper before they shout. Right now, silver appears to be whispering a message about tightening supply and institutional caution. Whether that message turns into a louder signal depends on how demand evolves in the coming months. If you've stayed with me this far, you already understand that awareness is your biggest advantage. Share this video with someone who follows financial markets and wants to stay ahead of potential shifts. And I want to hear your thoughts in the comments. Do you believe banks are truly facing a physical silver squeeze, or do you think the market will stabilize before reaching that point? Your perspective helps deepen the conversation. This is The Silent Collapse, reminding you that the biggest changes often begin quietly. Stay aware, stay curious, and most importantly, stay prepared for the signals others choose to ignore.